Andrew Holland from Ambit Investment Advisors is now joining us. Andrew, good morning. You would have looked at the Aditya Birla Grasim deal. What would be your first reaction? Is markets, getting much more pessimistic than what the impact of the deal would be? Because we've seen earlier deals from Birla Group, when they separated Aditya Birla Fashion, when they separated Ultratech, they have created a lot of value for investors.
Yeah, and I think that's what surprised the market. I mean, apart from being a hugely complicated deal, it doesn't seem to kind of make from what I've read from all brokers' reports, doesn't seem to make a great deal of sense from a restructuring of the whole group point of view. I mean, if you're an ABNL shareholder, you would say, well, what's the value of the financial business? And I've seen figures as high as the whole of the market cap. So you're holding that. That's the asset you're holding within that company, and now it's going to get diluted if you swap into Grasim. So there's kind of disappointment on that side. And then as a Grasim shareholder, yeah, you're getting the financial. That's good. But the underlying feeling is that still that cash flow would be used to somehow fund more of Idea Cellular's expansion plans or the kind of move by Geo into the market. So, I think because of that, people are just looking at the negatives rather than that there could be, longer term positives. And as you said, the Birla Group is, hugely good in corporate governance. So there's nothing I think that we're worrying about there. Maybe just have kind of felt that the benefits would be longer term, but obviously we're thinking that, or shareholders are thinking that, they don't want to wait that long. And there's a lot of moving parts that will have to happen before you start unlocking the whole value of this restructuring. So I think that's where the disappointment's coming from.
Right. How would, you view this deal? Say if, somebody asks you for advice that how would you go ahead and, vote for this? Would you vote in favor or not? What would be your first reaction?
No, I think I'd probably, as a shareholder, if I was one, then I'd want to hear from the management first to understand the deal in more detail. Obviously, what they announced yesterday is part of the overall plan, but obviously, their thinking behind it, I think would be something that I'd have to listen to first before deciding what I'd want to do.
Right. As far as Aditya Birla Nuvo is concerned, you would have tried to study the company earlier. It was a very complicated sort of a structure. And the main play over there was, or the main trigger over there was, going ahead, different businesses would get demerged. We would get long-term value unlocking coming in. Now that, except for the financial businesses, the other businesses are getting merged into Grasim. That's also a disappointment, or, the long-term value creation may take some time of separate businesses?
Yeah, so that's what you've highlighted is correct. I think if you're an ABNL shareholder, you were expecting demergers, and as I said, I've seen estimates where the financial business, is valued, or the sum of parts of it all is kind of valued at the kind of whole of the market cap of ABNL. So, you would be expecting to benefit from that. Now you're going to go into a merger of which you're going to own less of that financial services company. And obviously that, divestment, whether it's an IPO or sale or whatever it might be, will be, sometime next year if markets are favourable. So there's a long wait period now for all of this in terms of unlocking value for you.
And, with the valuations and, with the sort of investor patience, especially in such sort of deals, you think that wait is quite long?
Yeah, obviously the merger itself would not kind of take place till the end of the year, from what I can work out. And then they talked about possibly mid-year, calendar year 2017, to do something on the financial services side. But we all know these things, can take longer. And obviously it depends on market conditions in the middle of 2017.
Right. Just looking at the financial business, so In AB Nuvo, it's the financial services as well as the fashion business. These are the two most lucrative business, right?
Yeah, but I think everyone's expecting the financial services side to be the one which was the biggest growth area. I mean, if you just look around all of the different parts of that, whether it's NBFC, asset management, insurance and so forth. I mean, you're seeing valuations that are being put out there. So it's not that difficult to do a sum of parts, which I said I've seen figures as high as the whole market cap for the financial services business of ABN, so ABNL. So, that's where I think people were getting more excited, given the valuations you have within the markets at the moment in each of those constituent parts of the business. And that's where I think the disappointment is being seen and why the share price is down so much today.
Right. Let's talk about some other names as well apart from this deal and really what's happening in the market. So firstly, markets are up 77, 78 points, irrespective of this deal, looking in decently strong. You think any correction will be short-lived with the sort of liquidity that we have?
So, as I think we spoke last time, we're all markets globally are driven by liquidity at the moment, and you sometimes think, in the last few days you're thinking that maybe the liquidity is starting to ebb down. What we have is a difficult market in that, the indices might not be going down because obviously ETF money is still coming in and propping up the index. But some of the movement in the PSU banks yesterday was quite severe. So I think once a correction comes, once this liquidity bubble is burst, and it will be at some point, then the kind of the move downwards could be quite sharp, because I don't think ETFs will be staying around for too long if they think the risk-off trade is back on. So that's the concern, is that you can't fight this liquidity, so it could take markets a lot higher from where we even are today. So I'm not trying to be overly negative, but once it does change, then the valuations you're seeing in the Indian market at 19 times 1 year forward are just not it's just not fair value. So there's you'd have to see some contraction in the PEs first.
Right. As far as the overall valuations are concerned, globally, equity assets are trading at a higher valuation. That means that India can also for a while trade on higher valuations?
That's exactly what's happening. I mean, what you're seeing globally is that, liquidity is chasing all assets. All assets are going up. And obviously equity markets are kind of, this kind of, well, there's two parts to it, and two parts that worry me. One is this kind of Tina effect, there's no alternative but equities. And secondly, this left out feeling that, you have to put money to work because your markets are moving up. And the latter one is the more worrisome. So, as I said, I think once the liquidity bubble is burst, then valuations will have to crunch down. It depends what bursts that bubble, but once it does, then India, whilst I think is longer term I have no problems, it's the global factors which worry me more. And as we saw in January and February, that sentiment can turn very quickly in terms of negatives, and there's lots of negatives out there. It's just that we're just ignoring them at the moment.
Right. As far as earnings are concerned in Q1, no reason to see any upgrades, or only towards the end of Q3 or Q4 when we have, say, 6 months, 9 months numbers, we would be in a position to get an exact number of what can come in. Yeah.
So I think everyone got a little bit more excited, or the analyst community got excited at the last set of quarterly results, or the back end of them. And I think, if anything, this quarter's results have been, reasonably kind of, I'd say, neutral to more disappointing. So we certainly haven't seen any, major increases in analyst estimates. But anyway, our forecasts have been before the monsoon, or the outcome of the monsoons was always between 5 to 10% earnings growth if the monsoons are okay, and obviously with the seventh pay commission pay hike coming through, then we could see that earnings growth be more 10 to 15. But I don't see it being higher than that at the moment. So it is a bit of a second half expectation in terms of earnings starting to pick up. But I think at 19 times 1 year forward, that's pretty much priced in at the moment.
So you're saying that positives are priced in. Can you just tell us that what are the sort of negatives that we are looking at, or what can be negative? Can Fed rate hike be a negative? Can be a big negative? What are the potential risks that you're seeing?
So here's the negative. So I'd be doubtful if the Fed do go ahead with a rate hike this year. I mean, they seem to be fearful that what they do will have too much of an impact. And here's the dichotomy is that you have GDP growth at 1.2%, which would tell you that the jobs data should the unemployment rate should be a lot higher, and the unemployment rate is actually quite low, which is telling you that your GDP should be growing at 3%. So, there's something in between that's going wrong, and I'm not sure what it is. But obviously, all of the money that is being thrown into the system is really clearly not working in GDP. It might be in jobs growth, but is it real jobs growth in terms of people spending money? I think the second factor, which is, again, we're kind of ignoring because of liquidity, is the trade data that came out of China on Monday. Which was pretty bleak actually, but it showed imports from Australia down 22% and imports from Korea down 12%. So it tells me that China's still slowing, quite rapidly. So whether they'll have to depreciate or at least cut interest rates, if not look at depreciating the currency. Then, of course, we still have Europe, which is kind of hanging on by a thread to whether it's going to be in recession or not. I think we're a little bit too complacent about Brexit and the impacts. But if you look at the housing market in the UK, it's already trading downwards in central London by up to 10%. So yes, it could be attractive if you're a foreign buyer. But that there's a pain going through the housing market now, which is going to have a ripple effect into people's spending power as well going forward. So there's all of these things which are negatives, which I'm afraid we're just ignoring at the moment. At some point, fundamentals do come back, and So what I think is going to happen is that I think there's in the bond market something that will give at some point, and I think that's where the bubble is at the moment, and then that will rapidly go through to currencies, commodities, and then stock markets.
So it will create a situation like 2013.
Yeah, it's quite interesting. It feels a little bit like that, right? I mean, all emerging market bonds, are being everyone's rushing to buy them. Corporate bonds, emerging market corporate bonds, everyone's rushing to buy them to get yield. So yeah, it feels a little bit like that. I've seen that picture before. I kind of know what the ending might be. The good news is that India is not as vulnerable as it was back in 2013, and maybe it's another country, maybe it's I don't know, Thailand or Indonesia, which has a currency problem this time around. But we are in better shape. But when global factors happen like that, then obviously markets will obviously have to fall.
Right. How would you look at something like an Axis Bank or Yes Bank? So they are going up. They have been moving up recently. Yes Bank, good set of numbers, did deserve a re-rating. Axis Bank may not be that great set of numbers, but MSCI buying is keeping them active. And we got the MSCI data coming in today. So do you believe after the MSCI buying, they could see a little bit of cool off?
Could well be. I mean, obviously the MSCI buying will obviously skew those two banks in particular in the very short term. But what happens, as we all know, is that if market momentum is continues, then there's no reason that they should. But obviously, once that buying dries up, if markets were to fall, then these two could see a little bit more kind of fall than some of the other private banks in the short term, because Axis Bank's results were actually very poor. But because of liquidity and probably because of this MSCI rebalancing, then the share price has actually kind of moved higher, which is quite surprising actually.
Right. Can you also just tell us the bond bid that you just explained? Is that very positive for NBFCs and for banks?
Which part, sorry?
The previous answer you said that bond markets are seeing a great amount of action coming in, with rates coming down. Rates have come down further. Is it very, very positive for the banking or financial institution, or you believe it's largely in the price?
So if I look at it globally, the banking sector has actually been one of the, they have performed, but they haven't been a great performer. And in fact, if you look at the European banks, they're at valuations near to 2008. So, lower rates really haven't helped them. I think for India, though, obviously it will, because I think we have two things going for us. One is, GDP growth will start to accelerate in the second half of the year, and that will hopefully, help corporates kind of think about, starting to either expand or borrow more, and that will help the banking sector. So I think, in that respect, it's fine. But I'm not saying that interest rates are the great catalyst for the banking sector. The PSU banks themselves have a huge amount of problems, and you've seen that in the results. I mean, I think the problems, the identified problems in terms of, the big, large corporates which are in trouble, as kind of, is now being kind of, we're kind of overlooking that part and looking at the next part, which is the small and medium-sized enterprises, which is the next level of problems for the banks. And you've seen that consistently now with the PSU banks having to put more aside for that, and Bank of Baroda, I think, was one of them. So, there's still a lot of problems in the banking sector, which is not going away from us. Liquidity is pushing these share prices higher along with the markets, but fundamentally there's no reason to own them yet.
Right. As far as the banking space is concerned, generally you say a top or the bottom happens when IPOs start coming, a lot of fundraising activity starts happening. But it may not be the case for the banking sector. We are looking at Yes Bank raising a lot of funds. Citi is likely to sell Axis Bank's stake. RBL is coming up with an IPO. Don't you think that a lot of fundraising is happening? Or for banking it is different because it keeps on adding value rather than, just look at the valuations?
Well, if you look at the longer term, obviously, the Indian economy will continue to grow at a fast rate. So obviously, the banking sector would have to be a big beneficiary of that. And if I'm a private bank and can I get access at a good valuation to funds, and I know that a big, large swathe of the whole sector, i.e., PSU banks, are not in a position to take advantage, even when the economy starts to move higher or better, then it's a great opportunity for me to get out there to either expand branches, do M&A, whatever I want to do, and take their market share permanently away from them. And I think that's what the private banks are doing and have been doing consistently. But this is a kind of a great opportunity whilst these banks kind of get to grips with their NPA problems. And it's across the board. And, if I just take, say, SBI and their merger, I mean, that's going to, those mergers are just at the wrong time. I mean, management focus should be on rebuilding the bank rather than merging, which would just cause a lot more headaches and management, focus away from the core banking business. So if I'm a Yes Bank, an Access or a HDFC, I'm just going to say thank you. I'm going to go out there and take your market share.
Right. As far as some of the other beneficiaries are concerned from the NBFCs, so we've seen housing finance companies do very well. We've seen a lot of NBFCs getting re-rated. You think that's a slightly safer space? It's a slightly better space to be in rather than these banking names because of the asset quality, that they have shown constantly in terms of managing in a better way?
No, I mean, I think there's two parts to this. One is obviously the banking space. The private banks have, whilst they've not come unscathed, they've done a lot better than the PSU banks. and that's where they're taking market share. The NBFCs have obviously seen there's an opportunity outside of the PSU banks to take their market share, which is what they've been doing. But I think the valuations for NBFCs now are fairly much reflecting that kind of near-term growth. And of course, with all of these NBFCs, like any bank as well, is how they manage that growth going forward. So I think share prices might pause a little bit in the very short term, but I think what we're trying to say here is that the space which is going to suffer the most is going to be PSU banks, and the big beneficiaries are NBFCs and private banks. And that's the way it continues to look. To me, will continue to happen going forward. So, PSU banks, I don't know why the share prices have moved up.
Right. Just a word before we can conclude. Any new names that you've liked after the recent results that we've seen? Companies which have raised their guidance or given a good set of numbers where you believe it will continue. You look at a lot of mid-cap, small-cap names. Anything that you like?
Yeah, I mean, we haven't, we don't just buy in the back of results. Our sectors that we've been favouring have done quite well, which has been cement, the private banking sector, selectively some NBFCs, the auto sector, have been our kind of core holdings. And about a month or so ago, we got more excited about the valuations in pharma, so we've been adding large cap pharma over the past month or so, which has paid off very nicely, and we think that the valuations are still at a level where a re-rating will take them another 10 to 20% higher from where we are today.
Right. Just wanted to ask about the pharma pack, as you mentioned. Do you believe that the way to look at it is that majority of the regulatory issues are behind last 2 years, even for large cap pharma space has not been particularly that good? And we are coming to an end. It's always a mean reversion sort of a cycle. 3-4 years, they are very good, and 3-4 years, probably, you see such problems coming in. So we are coming towards the end of a regulatory issue, and you believe that Indian pharma will adjust, and again, we'll start seeing approvals coming in?
Yeah, you can't really say that you're at the end of it because, the FDA obviously will have their own, different views on that. But our take was 2 months ago was that, with all the FDA, notices being given, that that the worst was over for the sector, and valuations had been, crunched down to a level which we felt that all the bad news was there, and therefore, as companies worked on, kind of trying to overcome or kind of put straight their own processes for the FDA, that those approvals would come later on in the year. Therefore, valuations were compelling to jump in because they've been pushed down too high, and the fundamentals anyway were looking okay for quite a number of the pharma companies. So that's how we looked at it, and now we think that going forward, as approvals start to come through from the FDA, that will be the next kicker for share prices.
Right. And, in pharma, it's very different in terms of mid-cap and large cap. So any investor should focus on the large cap names because the performance over there has been very good, especially for someone, which has a history of over 10, 12 years.
Yeah, we've kept to the large cap pharma. We think that's where, obviously, any kind of changes that have to be made for FDA could be made a lot quicker than some of the mid-cap companies. And again, we'd rather stick with the large cap first and then look down as and when we need to. But the value is in the large cap, and that's where we focused our attention.
Right. Andrew, thank you so much for joining us this morning.